Hey guys, Sebastian Guerra here, partner and advisor here at Guerra Wealth Advisors, where we help families get to the point where work becomes an option and not an obligation. If you right now are entering retirement over the next couple years, or maybe you're already in retirement and you're trying to figure out how to make the best decisions with your money, and you're trying to learn how to minimize taxes, optimize your investments, and create a lasting legacy, well, I'm glad you found this channel because this is what this channel is all about. It's how to make better decisions with your wealth as you're entering the stage of retirement. Today we're going to be talking about something called the withdrawal strategy. You see, I think one of the biggest challenges that a lot of people have as they're entering the stage of retirement is that many of them have a lot of accounts in different locations. They have retirement accounts, they have 401ks, 403bs, savings, brokerage accounts, maybe Roth IRAs. They have all these different types of accounts, but now that we're entering the stage of retirement, well, the question is, well, where do we withdraw money from on a monthly basis to be able to maintain the quality of life that we're accustomed to? Right? Maybe you yourself, you might be retiring over the next couple of years, or maybe you're already retired and you need a certain amount of money to maintain your standard of living. Well, now the question is, well, where are you going to pull from on a monthly basis to maintain that standard of living? Do you need an extra $5,000 a month, $8,000 a month, $15,000 a month? How much money do you need on a monthly basis, and where are you going to withdraw from when you're entering the stage of retirement? And so if you have multiple accounts, you have retirement accounts, maybe Roth IRAs, brokerage accounts, 401ks, well, the question is, where do you pull the money from every single time you need to take out a dollar? And so today we're going to be talking about how to look at your money when it comes to taxes, because if you know how to make the right decisions on where you withdraw your money from, you can save up to over $100,000 in taxes throughout your retirement just simply by knowing where to withdraw money from on a yearly basis when it comes to tax optimization. So we got a question from a family recently. They're right now 65 years old and 62 years old. They needed about $12,000 a month to be able to maintain their standard of living, which, by the way, before you retire, you need to know that answer, right? How much money do you need to maintain the quality of life? Is it $12,000 a month, $15,000 a month, maybe only $5,000 a month? But you need to know that number. You should also know how much money you're going to be getting from Social Security. So if you don't know what that amount is, you should go to the website www.ssa.gov. You can go to the website, you can create a login, and then you'll know how much money you're going to get from Social Security. But then that leaves us with something called a gap. And you see, the challenge is that most people, once they're entering retirement, they're going to have something called an income gap, which is how much money do I need extra from my investments on a monthly basis to maintain the standard of living that I'm accustomed to today. So if in this case, they're going to need about $8,000, well, now the question is, well, where am I going to pull that from? And so that leads me to what are called the three different buckets. You see, in their specific case, they had about $1.5 million spread up in three different tax buckets. And so when I talk about what's called the tax bucket, normally what we start off is what's called the tax-deferred bucket. You see, the tax-deferred bucket is what we call 401ks, IRAs, 403bs, TSPs. You see, all of these accounts are growing tax deferred. And what that means is that later on in life, when you start withdrawing money from those accounts, you will have to pay taxes every time you withdraw money from those accounts. Then you have bucket number 2, which is what we call the taxable bucket. You see, these are things, for example, like CDs or money market accounts, or probably like a brokerage account. So if you have like a stock portfolio or a bond portfolio, any interest that generates on a weekly, yearly basis, you're going to need to report that as income tax on your tax return. So that means the interest gets taxed on a yearly basis, but your principal was already taxed. Then you have bucket number 3, which is what we call the Roth IRAs, which normally these are what we call tax-free vehicles. So all of the growth that you have on that account and all of the withdrawals, you never have to pay taxes on it. Now, the reason I bring up these 3 buckets is now what I want you to really understand is how these 3 buckets get taxed financially. The first thing that we need to understand is something called the standard deduction. You see, what the standard deduction means is that if you right now are making, say, $20,000 a year or $30,000 a year, there's a certain amount of money that you will not have to pay taxes depending whether you're married or you're single. So if right now you are married, you have what's called a $30,000 standard deduction in 2025. That means that your first $30,000 that you make, you don't even have to pay taxes on it. That's what's called the standard deduction. And if you're single, it's half of that amount. It's only $15,000. But if you are above the age of 65, well, the good news is you get $1,500 of an additional deduction that you can take. So if you're married, then that means you get $30,000. But if you guys are both above the age of 65 years old, then you get to write off an additional $3,000 off of your income tax. So in simple words, I can actually go and withdraw money from my IRAs and my 401ks, and I don't have to pay any taxes on the first $33,000 of withdrawals, as long as that's the only income that I have. So these are things that we need to start thinking about. If you want to get a free downloadable PDF where it walks you through the 5 top tax strategies that retirees should be implementing as they're entering retirement, you can text me the word money to 786-807-7001 so you can download it and you know exactly the strategies that you can be implementing as you're entering retirement. Unfortunately, a lot of accountants, a lot of financial planners, a lot of financial advisors really just focus a lot on the investment side. A lot of the accountants really just focus on tax preparation, but they're really not thinking about how to minimize taxes during retirement. So if you want to get access to that free PDF, you can text me to 786-807-7001. You can just text me the word money and I'll get that right over to you. So what are the 2 different scenarios that we need to start thinking about? Well, you have what are called single taxpayers, and then you have what are called married taxpayers. So if you right now are making, say, call it $50,000 and you are single, well, the good thing is that everything above that standard deduction, call it the $15,000 we spoke about earlier, then that means you need to pay 10% on everything from 0 all the way up to $11,925. But once you make above that $11,925, now you enter the next bracket, which is the 12% bracket. So $11,926 up to $48,000, now you're paying 12% in tax on that amount. Now, if you're married, for example, now you can be making between $23,000 and $96,950, and you're in the 12% bracket. But remember, keep this in mind. You still get your standard deduction of $33,000 if you're married and above the age of 65. Now, why is this so important? Because check this out. Let's say that I'm making $96,950 from my job, but I get that $33,000 of my standard deduction. I'm really not paying taxes on $96,000. I'm really paying taxes on about $63,000 once you wipe out that standard deduction. That means that technically you can be making all the way up to about $120,000 a year, and you're really still technically in that 12% tax bracket because of the standard deduction. Now, I know it might sound very technical right now, but why is this so important? Because as you're entering retirement and you now know that you need maybe call it $100,000 a year to live off of, well, you want to be very strategic in what bucket you're going to pull from when you're entering retirement. Because maybe what you might want to do is you might want to withdraw, call it $40,000 from your tax-deferred bucket. Maybe you might want to withdraw $20,000 from your taxable bucket. And maybe you might want to withdraw $10,000 from your tax-free bucket to be able to maintain your entire standard of living. And you see, this is where it gets really interesting. If you know how to withdraw money from the right bucket every single year, and you keep doing this for the next 3, 5, 10, 15, 20 years into retirement, this is how you can get your money to last you longer. Why? Because you're paying less money in taxes because you're being strategic on where you're withdrawing the money from every single year. And you're not doing this blind thing that most people do, is that they enter retirement, they know that they need $50,000 to pay their bills, and they just look at the first account and they pull money out of the first account that they look at. And that's where the mistake comes in. If you're looking to optimize your wealth, you want to be very strategic on where you're withdrawing money from. So now let's talk about this second bucket, which is what we call the taxable bucket. You see, this taxable bucket, we said that you only pay taxes on the gains, but the question is, well, how does that really work? So here's a very interesting piece of information that almost no one knows about. And I would even go to argue to say that most accountants, even probably your accountant, doesn't even know about this unless he really studies the subject of tax really well. And check this out. If you're married, did you know that you can make up to almost $90,000 a year of capital gains and you pay 0% in tax on the first $90,000? Why is this so powerful? Because let's just say that you are entering retirement and you know that you have this taxable bucket here in the middle, maybe a brokerage account, maybe you have some Apple stock, and you know you need to pay your bills. Well, if you're trying to be very strategic on paying the least amount of money in taxes, Well, maybe what you might want to do is you might want to sell some of those investments so that you don't have to pay any taxes on the first almost $90,000 of capital gains. Now, keep in mind, you cannot have any other sources of income. So if you're making $40,000 or $50,000 or $60,000 from Social Security, then that's something that needs to be factored into this conversation. But why is this important? Because you can be very strategic. And now here's the beautiful thing. You can go all the way up to $553,000 of income, and you're still only paying 15% in tax. Now, why is that so powerful? Because if you go and you look at, for example, this chart over here, which is the tax bracket chart, if you're making $553,000, you're in the 35% tax bracket. So if you're trying to be very strategic and you want to keep your taxes really, really low during retirement, we really need to know how to utilize these three buckets in the most optimal way. And then this brings us to pretty much bucket number 3, which is probably the most recognized bucket, especially because of the tax-free benefits that it has. So if you right now haven't set up a Roth IRA, I strongly advise you to consider setting one up. Now, the reason behind it is all of the growth that you have inside those accounts, you don't have to pay any taxes as it's growing. But then the beautiful thing is that once you start withdrawing the money from there, you don't have to pay any taxes on it either. So what does that mean? That might mean that, say in your scenario, you might need $100,000 to pay all of your bills on a yearly basis. But you might say, hey, you know what? Let's withdraw a little bit of money from my tax-deferred bucket, a little bit of money from my taxable bucket, and maybe a little bit of money from my tax-free bucket. And if you're doing it in that fashion, that's a way that you can still get the income that you want, that you need to maintain your lifestyle, but you're not throwing yourself into a higher bracket. And this is the part that most people make the mistake. They're not strategic about the withdrawals that they're making. They have a bunch of investments at a bunch of different locations, and every time they want to take out money, they take money from accounts, but they're not being intentional about where they're pulling the money from. So if you really got a lot of value out of this video and you know someone that's entering retirement or is probably already in retirement and they really take their money and their finance serious, if you can go ahead and just share this video with them. You see, as today we spoke about the subject of the optimal withdrawal strategy, I think it's super important that we really pay attention to the way we are withdrawing money from our accounts. Just this one little change during retirement can literally represent hundreds of thousands of dollars at the end of our life, that we can maximize our legacy, but this could only be done if we do an optimal withdrawal strategy. With that said, I'll see you guys next week.